Hi, Matt Callahan, Certified Financial Planner with Seaside Wealth Management. Here's an excerpt from our 2024 Retirement Planning Today course, and this is the investment section.
All right, Matt's going to take us with investments.
So, what's the number one rule with investments? Does everyone know? Oh, what was that?
Bitcoin.
No, but buy low, sell high, right? So, I put something in here. You think it's pretty common that, buy low, sell high. We hear that all the time. But in reality, a lot of people, what we see, looks more like this. Greed, buy. You hear the next best thing, Bitcoin being at its high, Nvidia at its high. Fear, sell. Oh, the market's going down. And then repeat till broke. So by the end of this, I promise you, all of you will be good investors, and we'll give you some tips here. I did put a few slides in here that feel free to take a picture. They're not in the book, so things like this if you just want a reminder. But some of the things we'll be talking about is that the need for sound investment strategy has never been more needed. What I mean by that is, now we have mutual funds, exchange-traded funds, indexing. And so we'll talk about the different things like stocks, mutual funds, exchange-traded funds, and then a few of the other cash accounts, because we've seen now finally after, 10 years, there's an interest rate on cash accounts or high-yield savings. And so number one thing is that investment selection should be based on factors including objectives, time horizons, your current investments. As Brad mentioned last time, did he leave? Oh, as Brad mentioned last time, your time horizon. Everyone thinks that retirement is the end game, but we're looking at retirement as that new season of life, and so the starting point. And there may be 20, 30, or 40 years in your retirement, so don't get too conservative in your portfolio because the stocks are going to be your number one thing to keep up with inflation and your purchasing power strong. And then consider why you're investing. I'm sure you hear your neighbors or friends talking about, let's look at these growth stocks. We want the Magnificent Seven stocks, right? Or you've got your other friends saying, it's all about income. We don't want to take any risk. We want those dividend-paying stocks. And then where we find, Brad and I, we like to look at growth and income, the sum of both worlds. It's an extra layer of added diversification. So you have to decide what are your objectives and your time horizon there. And so I put this slide in here as well. What we're looking at here, it's called the efficient frontier. And a couple of people back in the day won Nobel Prizes for this strategy here. And what it's saying on the bottom here is your risk. And in the investment world, we measure risk by standard deviation. And so more risk, the higher the number. And then on the side here is the rate of return. And the simple explanation of this is that for a given level of risk, you should receive a certain expected return. And so that's the efficient frontier. There's no way you can be above that efficient frontier. Most often we find people below this line, and that means that you're taking on more risk than you should, and your portfolio is actually being very inefficient. Another thing that it's pointing out, and you can't see, but we have different portfolios up here. The first one is a 100% bond portfolio, and then a 25% stock portfolio and 75% bonds. And you can see here, with a 100% bond portfolio, it's more risky and you're getting less return than adding just 25% stock to the overall portfolio. So diversification can actually add increased rate of return and be less risky. And then following it along the line, 50-50 stocks to bonds, 40% bonds, 60% stock, 30% bonds, 70% stocks, and then a 100% stock portfolio. So I would just encourage you to look under the hood a little bit to make sure that you're being efficient, because those returns can help you out over the long term. And so time horizon, like we talked about, most people as they're getting older have a shorter time horizon. This is true, but again, not getting too conservative too soon. And so here's something to consider. This isn't in the book either, but if you want to look up, it's called sequence of returns risk. This is a serious risk that you may run into if you're going into retirement. Maybe it's in the next couple years. And what this is showing, we're looking at two different things, each column here, and I'll go through it shortly. It's the same investment value for each person, $100,000. They're taking out $5,000 with withdrawal. And then the return. So this is someone that goes into retirement with positive rates of return, 8%, 11% positive, 18% positive, 14% positive, and so on, and then start getting negative returns in their later years. And then so the difference here is they flip-flop the return. So the same exact numbers, but now we've got -5 starting out, -6 the next year, -15, and so on till we're back at 8 like they started off here. And so you can see the investment portfolio growing even though they're taking dollars out on this side and actually ending at 15 years later with 105, so more in their investment portfolio than they started. And then on the other end, with negative returns coming out first, they're actually potentially running out of money in retirement. And so over the same time frame, both received 4% average rate of return. So I know the average returns are a little low, but you get the concept that it may make sense to work one more year longer, which could be a benefit. Think about it, if you work one more year, it's actually buying 2 years of retirement. And what I mean by that is that it's one more year of you getting income and not having to take distributions from your investment accounts, and then also another year of maybe contributing to your qualified retirement account. Does this one make sense? Yeah.
What is it? I didn't understand what determined what happened here.
So this is, yeah, great question. This is investor A and investor B, and they're retiring at this different times. First investor gets positive returns at the beginning of retirement and negative at the end.
Oh, meaning they're withdrawing money?
Yeah, they're each withdrawing $5,000 out of their $100,000 portfolio. But the difference is the rates of return are the same, but just flip-flopped. So they're both averaging 4% over the long term, but investor B started with negative returns at the beginning of retirement.
Meaning they did not withdraw anything?
They still were withdrawing the $5,000.
They made that investment. What determined the difference?
The difference is the rates of return.
So just the investments that they chose?
Based on their portfolio.
Well, based on the portfolio. So at different times, not at the same time. These are two different times. If you retired with positive returns first, or if you retired and there was negative returns.
But what determines that?
I think it's just an example.
Right, not at the same, just the stock market. You can't control the rates of return. So something you just want to consider is when you're retiring, is the market down? You may not want to retire at that moment.
If the market is down, and that's a bad time because then you get onto this curve.
It could. So it's called sequence of returns risk, meaning that if you're going into retirement and the market's going down and you're taking distributions out, you're taking a double hit on your portfolio. And so you're losing value because you're still taking dollars out to fund retirement and the market's down at the beginning.
What if it's in 2008 and you had to do that?
So, yeah, keep working, or maybe you use Social Security. Maybe you just have to turn that lever on to supplement retirement.
Oh, I see. Or you can take it out and immediately put it to Roth. Immediately reinvest it. You can take it from your 401k.
I don't think you'd want to take distributions out of like a Roth conversion if the market's, you would maybe if you have the cash available, but if you're in distribution mode in retirement, you may not want to take extra distributions out.
Yeah, I mean, but if you have to have a certain minimum that you have to start withdrawing because of the retirement age.
That's true. If it's required minimum distribution age, that's true. This is more of a concept when you're first going into retirement, when you have the choice to take distributions or not. Yeah, so you may not want to retire if the markets are down at the beginning.
Because you need to give your portfolio time.
Yeah, right.
Yeah.
Is that okay?
This is just luck.
I mean,
Different timing, right?
different time. Yeah, it depends. I mean, you can't control the investments, so right. but we have some tips on how you can maybe weather the storm a little bit easier, so we'll get there. So we want to make sure when you're looking, before you're making any changes to your portfolio, always look at the current investments and make sure that whatever you have in place, not to just blow out of them. There could be tax consequences that are involved there. So maybe there's a phased in way to get into your new investment portfolio. And then so a lot of investment categories. There are more investments to choose from, more than ever. We'll give you some tips on the asset classes that you should choose from to build your overall portfolio. And then you also need to decide where you're going to invest. Is it going to be domestic? Is it going to be internationally? Is it going to be a combination of the two? And then we'll break down the choices into two categories. But really you just need to know two things. There's loaning your money, and then there's purchasing and owning an asset. So I know there's a couple business owners in here. Is anyone else a business owner? Okay, so well, everyone in here, if you own stocks, you're actually a business owner. When you're purchasing stocks, you are purchasing a piece of ownership in that company. That's why you could participate in getting those dividends, or they actually invite you to go out to their annual meetings if you want to. And so I put this in here, CDs and money market accounts. Like I said, now we've seen higher interest than we've seen in a while. And the difference here is that the CDs are timed. So banks will offer you, if you hold this CD for 1 year, they'll pay you 5% return over that time period. Money markets are more liquid than that. There's no time frame. But the pro and con here is that you're getting that guarantee over a certain time frame, but it's locked in. The pro and con here is that you could get, you get maybe higher return and it's more flexible, but these interest rates can go down at any moment. And so bonds, another common type of loan investment are bonds. It's like an IOU with a government or company. So they're saying they'll pay you a certain interest rate for lending them money during that time. So there we go. Length of the term. So I'll give you a nice chart of how to decide what your bonds look like and why you're getting the compensation you are. So to read this chart, if we see high quality and short term, then that's not taking very much risk. So the bonds won't pay you that much interest. But if you take some of the credit rating down and then you increase the length of the term, then you'll get compensated for a higher interest rate because you're taking more risk. So similar to the efficient frontier with bonds, the lower the quality, so the more risk you're taking, and the longer the term that you're holding it, they're going to offer you a higher interest rate. But be careful. We've seen a lot of people not recently, over time, that they see these high yielding bond funds, 8-9% yields, and we say just be careful there, because the reason you're getting compensated is because that bond is very volatile. There's a lot of up and down movement in there. And so although you are getting a high interest rate, it's performing more like a stock. So if you think you're in a 70% stock portfolio and 30% bonds, and 10% of those bonds are in high yield, it's more like you're an 80% stock portfolio and a 20% bond portfolio, or 80% stock, 20% bonds. And not the end of the world. We just want you to know what you're investing in and what are the reasons behind it. And so we put this in here too. It's just the grading, credit ratings. We've got Moody and Standard & Poor's and Fitch. If it's triple B or A, or B, AA or above, then we call it investment grade, so higher quality. And then non-investment grade is below that. So the further right you go on that graph, that's when you're getting in the lower quality. So these most likely will be paying a higher interest, but these are safer and have the ability to pay you back. All right, and I just wanted to go over a couple. There's basically 3 bond categories. There's taxable bonds and corporate bonds and treasury bonds. The corporate bonds you most likely want to put in your IRAs. They have the income that they're paying. Remember, ordinary income on the corporate bonds. Your taxable bonds, there could be municipal bonds that you may want to put into your trust account or any other non-qualified account. And if you want to see, does it make sense, should I have corporate bonds or muni bonds, you can do the tax equivalent yield. And the way to find that out, it's take the interest rate that the municipal bond is paying and divide it by 1 minus your tax rate. And that'll give you what the rate of return you need in a corporate bond to equal that municipal bond rate.
So municipal bonds do not have, they're not taxed as much?
Great question. So municipal bonds aren't taxed as much. So muni bonds are not taxed federally. And you can actually get a state muni bond. So you could get a California muni bond that would not be federally or state taxed. Okay, owning investments, like we talked about, you are owners in the companies. You can also invest by purchasing ownership in a company or assets. This is also referred to as purchasing an equity investment. All right. So, like we talked about again, if I'm getting ahead of myself, if you guys have always wanted to be a business owner, then buying stock is the easiest way to do that. It takes a very low capital, and your dollars you can stretch out between thousands of different companies. So advantages of stock ownership, you can have capital appreciation, so the stocks you're buying, they can grow in value. They can also pay you dividends, and then they are the best that we've seen over the long term as an inflation hedge to keep your purchasing power strong.
If you bought one of those like Cs that are really risky and the corporation goes bankrupt, you lose all your money?
So CD?
No.
Oh.
The
Stop.
ratings on this.
Or a bond.
Oh, bond. That, yeah, so great question. The bond, I mean, that's what you're hoping that their ability to pay you back is going to be based on that rating. So the lower the rating, there could be a potential for them going under. And then same thing for stocks. I mean, stocks, there's no guarantee that that they can't lose value either. So you just want to be careful, and we'll get into it about diversification and how to protect against the volatility in the market. So indices, Brad talked about this earlier, and there's a number of different indices that we track. And so a market indice just tracks a sample investment. So for example, there's the S&P 500. So that tracks the largest 500 companies, right? And most people, when you're watching the news, they're talking about the market. And so that is the S&P 500. If you have a globally diversified portfolio, you may not want to compare yourself against just one indice. You may want to have a number, 7 to 9 different asset classes and track your returns that way. And what we would want you to do even more is when you have your financial plan built out with your goals and objectives that you want to accomplish, if your plan is saying you need 7% to make your plan come to life, you may not need to take unnecessary risk, right? We want to make sure that you don't run out of money in retirement. And so I put a number of different indices in here. Like we talked about now, the S&P 500, largest US companies. The Russell 2000 are the small U.S. companies. The Bloomberg U.S. Ag are the bonds. The World Real Estate Index. International small companies. You've got emerging markets, and you've got international large companies. So we would like to see you build a portfolio having all of these different indices because, last year the S&P did really good, and you probably participated in that. But just so you know, underneath the hood of that, there were only 7 companies that really drove all of that return. The other 493 were actually, they ended up positive, but there was a time that 493 companies in that index were down for the year. So I don't know about you, but I don't know how you would know how to pick the 7 stocks during that time. And then even if you got it right, the hard part would be, okay, when do you get out, and how do you know which stocks are going to be next, right? And so our thing, I wouldn't recommend this, but if you just invested in the S&P 500, at least you're diversified between 500 names and not just trying to pick the 7 names that you think might do good.
I hear, though, that the S&P 500 is an international, essentially market, because those companies do business all over the world. Is that not really true, or you don't buy into that?
Yeah, some people will say yes, some people will say no. What you're talking about is the place of domicile of the business, or where the majority of the assets are being purchased from that company. But if it's the S&P 500, most people I think would say that those are just U.S. companies. But I agree.
The earnings per share, close to 50% are derived from abroad, right?
Right.
Yes, yeah, right.
So, I mean, that hedges you right there, in terms of not just being exposed to the U.S.
Mm-hmm. So this is good. Brad's going to talk about, there's this thing called the lost decade, and there's a time that you may have hated yourself just being invested in the S&P 500. So we'll get there. Yeah.
Quick question, I saw the real estate, like for example, there are real estate indexes, but you look at the trend and you look at the housing market, the houses always go up, but those stocks never go up like the houses go up.
Great. This is publicly traded real estate, so this is
So
including
where's that money going if the houses are going up?
commercial real estate has taken a real hit because of COVID. So people, I mean, there's a lot of things that go into that with this here.
Okay.
Yeah.
What is the use of the index? It's like to compare like how you're doing compared to the index? Is that?
Technically, yes. So some people will use the S&P, for example, as what they're comparing their portfolio to. So the S&P did 26.2% last year or something like that. And if your portfolio did 12, you're going to say you underperformed the index that you're tracking. But I would argue not to just use the S&P as the index, because your portfolio should own all of these different indices in there. So you're a combination of all of these, and we're trying to keep you hovering in the middle rather than having those big highs and those really big lows.
Why would somebody say we want to do less than the index?
Oh, to get less.
We don't want to meet the index. We want to perform less than the index. Does that make any sense?
Absolutely. If your plan says that you only need to get 6%, remember that efficient frontier, that you need 6%, you should only take a given amount of risk, right? So yeah, perfect example. We say, have your plan dictate what you want your goals and objectives to be, and have the investments be the portion that helps you get there. So don't take unnecessary risk if you don't have to. Okay, so we talked about the Standard & Poor's as 500 largest U.S. A lot of people will compare themselves to the Dow Jones. This one is even worse, in my opinion, for a comparison, because it's only 30 well-established U.S. stocks. And so I wouldn't use the Dow Jones. And this is the thing on the news you're going to hear, oh, the Dow's down 300 points. And you're thinking, oh no, my portfolio is down a lot too. It most likely is down, but with that diversified portfolio, you're hopefully not capturing all that downside capture. And then the NASDAQ, this is a market weighted, about 3,000 common equities, and that's around the world. So we're getting better, but it's usually the tech companies. And then bulls and bears. I'm sure you all hear this, that, oh, I'm bullish on the market. That's just a fancy way of saying, I think the market's going up, or the market is already going up. It's a bull market. And then, so bulls are optimistic of stocks going up. There's a typo in the book. I just want to be clear. It says bear markets, also known as a correction. So hold on, we'll start here. Bear markets are when the market is down 20% from its previous high. A correction is when the market's down 10% from its high. So if people are talking, hey, we're heading into a correction, that means the market, or the S&P 500, is down 10%. And I want to point out to the bear markets, remember the last 11 years or so, the markets just seemed to go up, up, and up. And then when they finally went down, we said, what gives? The market must be broken. I just want to remind you that bear markets on average happen about every 4 years. So this is actually normal that we see the markets go down. And this is when we see that greed, buy, fear, sell, right? But I don't know any other product or thing in the world that when there's a discount on the product that you want, that people are not buying. So pick your Youre, Lululemon. If they have a 50% discount on the door, are you running away from the store? Are you going, I would buy everything in there, right? So think of the market as that, where, hey, we're purchasing at a discount. Let's stay in there and be some of the good investors. Does anyone have stock options? You do? Okay, do you know what type are they incentive stock options? Okay, we won't spend a lot of time here. We can dive in your lab if it is, but just know if you have incentive stock options or non-qualified stock options, there's some unique tax strategies that you can get out of that. But if you have RSUs, restricted stock units, this is a wonderful tool. If you have RSUs, a great way to get out of them. They're a gift basically from your employer. You're being taxed at your W-2 income as soon as you get them. So the strategy that you could use is get the RSUs, sell them right away, and then you can go take the cash and invest in a globally diversified portfolio. So a really easy, or not easy, a good way to get out of the concentration of the stock and get in a diversified portfolio. Okay. Boom. Okay, so do-it-yourself investing. Maybe a lot of you here are because you've been doing it yourself along the way, but most people that we see once they start getting to retirement, it's like, this is a lot of work, it's a full-time job. I want to, start delegating this away because it takes a lot of extensive knowledge, experience is required to be successful. A large capital investment is required to build a diversified portfolio. How do you decide how to build the diversified portfolio? Discipline is required. This is one of the big ones here. Who's stopping you or helping coach you for when the markets are going down and you want to just act irrationally during that time? And then a lot of the time and effort is required to select and monitor the investments. And then selection should be complementing the goals of your comprehensive plans. And I'll show you here in a few slides of the mistakes that can be costly. And I'm saying they can derail your financial plan with one mistake every year for a 30-year period. And so I put this slide in here. I thought it was pretty cool just to see, or scary. What we're looking at is the S&P 500 index, long-term average of about 10%. The average equity investor, so the do-it-yourselfer, 7.13. You're like, well, what gives? What's going on here? This is loss of return because of making those poor mistakes while you're investing. And then the same thing in the bond market. So the Bloomberg bond index, 5.2 over the long term. Average bond or fixed income investor, less than 1%. So like we said, these are real returns and dollars in your pocket to help you retire. And so, is anyone working with a financial advisor now? Okay, great. This is a study from Vanguard, and we just wanted to put this in here so you can see where value actually comes from. And what we found, or what Vanguard found, and if you don't know, Vanguard is the largest, or one of the largest investment management firms. Very low cost, we love Vanguard, and so I thought it was unique that a passive investment company had this out. But it says suitable investment allocation using funds or ETFs. Not much value on just picking the funds or ETFs that you're using, but cost effectiveness. We've talked a number of times about the internal expense ratio, right? That hidden cost that's just taken right off of your investments. That could save you about 86 basis points or 0.86%. Asset location, Brad did really good talking about, let's put your tax-efficient funds in taxable accounts, tax-inefficient in your retirement accounts. So that can add up to 42 basis points. And then how we started this is total return or income investing better. Doesn't really matter, they'll both get you there, and advisor's not necessarily providing any value there. Regular rebalancing. Does anyone have a rebalance schedule that they on every clockwork? Okay, so some people will say, well, when do you do it? Is it quarterly? Is it annually? Is it on an as-needed basis? At a minimum, we'd like to see you do it at least once a year. And so if you're struggling when to do it, maybe draw a line in the sand, pick a day of the year, and then every year take emotion out of it and rebalance your portfolio at that time. And then spending strategy for drawdowns. So, okay, now you've worked really hard, you built up your assets. What's the most tax-efficient strategy to get those dollars back to you? And then the number one thing, here's that we've been talking about the costly mistakes, is making those poor decisions when the markets are going up and down. That can cost or save you about 1.5%. So overall, adding about 3% of return for you by not, or by using these tools here. I love this one. You guys should get a picture of this for sure. And so what we're looking at here is the stock market, so the S&P 500 from 2000 to 2023 against a diversified portfolio. And so we're defining that as 60% stock, 40% bonds. And watch this, how it goes. So from 2000 to 2002, The S&P 500 was down 40.1%. A diversified portfolio was down 15.7%. Here's how you felt as investors. I lost money, right? Makes sense. 2003 to 2007, the stock market was up 82.9. A diversified portfolio was up 91.5. Wow, this actually doesn't happen very often, but you're happy, smiley face, diversification works. 2008, minus 37%, right? This mix was down 28.5. Doesn't feel good. No one wants to see the negative returns. I lost money. 2009 to 2019, the market up 351. Globally diversified up 237. This is huge, right? 237. I didn't make as much money. Q1 of 2020, remember COVID, the fastest decline in the market? It was down 30.4 during that time frame. A diversified portfolio down 24.2. Again, I lost money. 2020, 2021, up 119 versus up 69.8. I didn't make as much. And so all the way bottom, if we look, 2023, the market was up 26.3%, diversified up 15.9%. But if you look at the time frame from beginning to end here, a $100,000 investment was up to $490,770 in the S&P 500, and then a globally diversified portfolio, $491,430. Diversification works even though it doesn't feel like you're winning. And why I like to show this is because after going through this class, if you feel any market environment that you're not happy, you're probably investing correctly. So if you're not happy, the investments are doing good. Does that make sense?
And is this also what I was asking about, why performing below the index might be a good thing?
Yeah, so another way to say it is now that you have, instead of just the S&P 500, one asset class, you have 7 to 9 different areas of the market. So the ups and downs, you're never going to be in first place, but you won't ever be in last place. You want to try to cover and stay hovering in the middle, right? And that can help with the previous slide of your behavior. I mean, if the downs aren't as bad, it's still not going to feel good. But if you're here and it's down here, maybe that keeps you in the investments longer and keeps your portfolios working for you along the way. And then another thing, this is a great one. So this is the U.S. stock market historical average of 10% a year, right? We all know that. But here's how it actually looks. You can't really see, but in these little boxes, it's different years. So 6 times the market has been in a bear market territory, down 20%. Losses of 0 to 20, 19 times. Less than average, 0 to 8%, 14 times. Here's the average return. So the average over the long term is 10%. It's only actually been about 10% 6 times. And then better than average, 15%. And then greater than 20% return, 36 times. So what we're looking at here is that you never know if it's going to be a really high year or a really low year. You kind of have to be invested through all market environments because we don't know when these are going to happen. And that's where you're going to get your long-term rate of return that you're looking for. Is any given year. So just keep in mind that 10% doesn't just happen. You got to withstand the ups and downs.
I have a quick question.
Yeah.
So when you say invest those 7 or 9 classes in a couple of slides,
Yeah.
are those the Russell, the S&P 500, and the international? So basically, you search for the right class, whatever the Vanguard or whoever is offering that, and then just pick 5.
That's perfect. Brad, you have to pay him later too. Well, we're going to get there. I'll show you that. Yeah, that's exactly what you need to do.
The tickers for all those 9. Then we'll go and do it.
Yeah, but then you need to decide how much percentages to each of those that you need to have it working for you. So it may not be equal portions.
But as you look in here, they go up and down, and if you start panicking and moving in the wrong places, you might actually, instead of on a 90K, it would be less than...
Right. So that's actually perfect here. So this, exactly to your point, so good days happen in bad markets. What we're looking at here is 92 to 2021, and this chart is saying that 50% of the best stock market days happened in bear markets. So when the market was down 20% or more, 50% of the best days happen. So you hear these people, oh, the market's going down, we need to sell and go to cash. We would say, hold on, don't do that. You're going to miss some of the best days in the market. And it gets worse. I'll show you here in a second. Let's say that you have a $10,000 investment over the same time frame. So over these 30 years, if you were fully invested in all market days, all the ups, all the downs, and everything in between, this portfolio would have been up $208,000. If you missed 10 of the best days during that 30-year period, 10 days over 30 years, you would have seen a decrease in your value of 54%. Yeah, right? And then so missed 20 days in that 30 years, you're down 73% compared to just being invested. And then if you missed one day a year for 30 years of the best days, you're seeing 83% less in your portfolio. I mean, it really does pay off to stay invested, even though it doesn't feel good along the way. So remember, we already know that if you're not feeling good, you're doing the right thing.
Sorry, go ahead.
Well, you say to reevaluate everything every year, but this is telling me I'm supposed to keep it where it is.
No, so great. No, so the rebound.
Why are we reevaluating?
Yes, I love this question. So what she's asking, why would you rebalance the portfolio if you're supposed to stay invested? Well, if you've got a number of those different areas of the market, right, some of them will be doing better than others. That's how diversification is working. And so you want to trim the one that's being a winner. Remember, it sounds, hey, I want to let the winner ride like it's doing good. Well, we want to trim the winner to buy the loser. So that's buying low, selling high, and you want to keep your portfolio in the proper proportions. So staying invested that's rebalancing isn't selling out, it's trimming the winners to purchase the losers to keep your plan and allocation on target. Does that make sense?
Yes.
Okay.
What's your perspective on target retirement date, investing in those?
I like them for a 401k when you don't have someone being able to watch your investments on an everyday basis. They do come with a cost. Typically, they're higher because there is a manager going up. So a target date, what he's asking is that it's a globally diversified portfolio that's based upon your retirement date. So it's more risky when you're in your younger years, and it gets more conservative or rebalances for you automatically as you get to retirement age. And so they're buying and selling and rebalancing for you. So it's great to kind of set it and forget it. And they typically get pretty good returns, but just know what you're paying for because they do come with a cost. But like Brad said too, I mean, as soon as you can get out of the 401k and roll it into your IRA, now you've opened up a world of options to get the same asset allocation, but maybe cheaper. Okay, so perfect. So there's we got to pay you too. Many people prefer to focus on their careers and families, and they want to have professional managers. There are many choices when it comes to managers. We're going to focus on mutual funds and exchange-traded funds. So a mutual fund is just a basket of securities. Each mutual fund can have its own objective. And an exchange-traded fund is very similar to a mutual fund, that it can have an objective for you as well. So here's the main difference. A mutual fund gets if you purchase your mutual fund at 9 o'clock, I purchase mine at 10 o'clock, we get the same price at the end of the day, right? With an exchange-traded fund, if you purchase the 9 o'clock price and I purchase the 10 o'clock, you're getting 9 o'clock price, I'm getting 10. So they trade on an exchange in real time. So this isn't saying buy exchange-traded funds because you want to go market timing and try to beat the market, right? But what we find is that they, typically are way cheaper than their mutual fund counterpart, and then two, they're actually more tax efficient. Scott and I were talking on the break, and he's been getting hit with these capital gains taxes because he owns some mutual funds. He's not selling any of these mutual funds, but the professional manager inside that fund is buying and selling on his behalf. And they push down those capital gains to the investor. And so if you don't want that, you may want to look at a couple of things. There's something called what is it called? Oh, I just lost it. It is called turnover ratio. Turnover ratio, the higher the ratio, the more that manager is buying and selling in that portfolio. So be careful and know about the turnover ratio. And then the exchange-traded funds, they're more tax efficient because there's not that manager buying and selling on the day-to-day. They're tracking an index. And so the advantages of professionally managed funds include the investment research, so that takes it out of your hair, the experience of the portfolio managers. Smaller investments achieve greater diversification. So in your mutual funds, you don't have to purchase whole shares. You can actually buy fractional pieces of a mutual fund. So with an exchange traded fund, just know that you do have to purchase one whole share to buy that exchange traded fund. And so mutual funds, there's over 7,000 different mutual funds in the world. So how do you know which one to choose? Some are more expensive than the others. Is it worth paying that extra price? And so about mutual funds, they're designed, like we said, with a specific objective that will, and to narrow down the choice. Have you guys looked at the prospectuses that your investments give you? A thick book or anything? Yeah. So if you need a nap, I would recommend opening that thing up and you'll be good to go. But there's another thing you can look at. It's called the fact sheet. If you Google the fund and look up the fact sheet, it's about a page or two. It'll give you all the info you're looking for, like the top 10 companies you're investing in, where in the world you're investing in, the expenses, the manager tenure, and all of these different things. And of course, let's look at the fees. That can be a huge drag on your portfolio. Okay, and so yeah, when you buy shares in a mutual fund, your money is pooled with the assets of other investors. So it's like we talked about earlier, a pool of investments, and you're owning a small piece of it. And then again, the managers are buying and selling on your behalf, and those get passed down to you. But again, then if you make sells or trades of your mutual funds, there could be additional taxes there as well. All right, cool. Okay, so Enron. Does everyone remember Enron? Where I'm going with this is that some fund managers, I know I talked, oh, hey, you should be index or ETFs. Why are you paying a fund manager? Expenses are the worst, right? I don't necessarily mean that. There are some fund managers out there. Back in the day, Enron was a company that was, generating a lot of wealth for people. And if you weren't investing in Enron, you were nobody. There was a fund company during that time that was going out and doing research for these different companies to see if they wanted to invest in it, actively managed company. And they went to Enron. They said, you know what, something's a little fishy here. We're not going to invest in this company. Everyone thought they were crazy, right? Why you're the only one not investing in this company? And so it can make sense to purchase actively managed mutual funds. Just know a couple of things. What you're buying, is there value there? Because if there's value, then it can make sense. The whole thing we just want you to be aware of is that most active mutual funds aren't the best funds again the next year. It's very hard to beat and be right both times. So that's, buying the company and then selling the company at the right time. We talked about prospectuses, perfect. And then so mutual fund families. Now we know that we want to build a globally diversified portfolio, and we know that some managers can perform well in different areas of the market. You may just want to look at different fund families. So there's American funds out there. There's BlackRock, Vanguard, like we talked about. And you can build a great portfolio with any one of those different fund families or using their target date fund. But the way I would look at it is like a baseball team. It's baseball season, right? Are Padres having a winning season this year? Or? I'm going to take that as a yes. So where I'm going with this is that you want your best first baseman playing first base, right? You don't want your best first baseman playing catcher necessarily. And so you could build a team. They're all professionals, probably can play each of these positions just fine. But you may want to consider, okay, my catcher, I'm going to Vanguard. They do the best in this area. I'm going to BlackRock. They have the best first baseman. I'm going to Fidelity. They have the best center fielder. I'm going to Dimensional funds, they have the best left fielder, and then build your portfolio with the best person or best fund manager or company to fill in each of those sleeves, like your S&P 500 sleeve or your emerging markets or your bond portfolio. So just know that you have the flexibility if you're not using the target date fund, but you can see what companies are doing well in which areas of the market. And then so we talked about exchange traded funds. Cool. And then so we put this chart in your book, a really clean way to see ETFs versus index funds and then active managers, and just the different features that each of them have and a clear view next to all of them. You can build a portfolio with active managers, index funds, and ETFs. You can use all of any of them and just be aware of what you're purchasing and what's the objective of what it's trying to do. And then separately managed accounts, we won't spend too much time here, but think of a separately managed account as buying a fund manager, but not the mutual fund. So the fund manager builds the funds, has the stocks and bonds on the inside. You don't technically own the individual securities inside that mutual fund. You can go to a fund manager and ask for a separately managed account, and this is more tax advantageous for you because now you get to control if you're buying or selling the individual holdings. But they do have large individual account minimums, so 100,000 is typically the minimum to get into these, and so that way you can own the actual individual stocks of your portfolio. Another thing that is coming out, we think maybe the way of the future is what is it called, Brad? The indexing? Direct indexing. So you can own the broad index, but instead of just owning the mutual fund or ETF, you actually can own the individual holdings or the stocks and bonds within those indexes.
For the same weighting, or?
Typically, yeah, pretty close.
So what's the advantage?
Yeah, you can be more tax efficient in there with having, and then do tax loss harvesting as well if you wanted. Be more robust in the portfolio. Okay, so tax-deferred annuities. Does anyone have tax-deferred annuities in here? Okay, so they used to come with a very bad negative connotation, right? Oh, annuities, these guys out there, they're selling me this product, they're getting huge commissions, and typically I agree with that. But I just wanted to go over that the tax efficiency of it or lack thereof. And so these, what I would recommend you guys thinking as an annuity is a stream of income that you can't outlive. There's a lot of these products out there. They're trying to turn annuities into investment vehicles. I think it's a very inefficient way to grow your wealth because they do typically come associated with high fees and expenses along the way. So it may recommend you putting dollars into a taxable investment account, growing those over the long term. And if you need an annuity, find out what's your income that you need, maybe purchasing at that moment. But I just want to show you just real quick. With an annuity, let's say that you put, let's just call it 100K. 100K into an annuity, and then it grew to 200K. Well, there's two things. There's a non-annuitized annuity, and then there's annuitized annuity. The difference is that if it's annuitized, you're taking the dollars inside the contract, and you're saying, annuity company, give me a stream of income that I can't outlive. So be careful. If you do that, it's typically irreversible, so know what you're getting into there. But if you don't annuitize it, then you can actually have flexibility to take dollars out of it, and it doesn't have to be annuitized. Just be aware that if it's grown to 200,000, it has the LIFO tax effect, meaning that your gains come out first. So you don't get your cost basis out of the contract until you've gone through all of your gains. And then if you annuitize it, think of it as drawing a line down the middle. Part of the return to you is part basis and part taxable. So it could be more tax efficient if you annuitize the contract. All right, cool. And then again, so there's two different ones. There's fixed annuities and variable annuities. Fixed annuities are just, they give you a fixed rate and that's what you're getting from them. Variable annuities, you can invest in different sub-accounts, which is just a fancy way of saying areas of the market. And so they can go up and down. Oh.
Is it a loaning money to somebody? When you say, yeah, give me annuities, what is that person doing?
They're exchanging the contract of whatever dollars they put into it for, it's an insurance product. So we're saying, hey, I invested 200,000 into this account. It's now worth 400,000. How much will you give me for the rest of my life if I give you this back? And they'll say, we'll give you $300 a month for the rest of your life if you give us this contract. I'm making numbers up, but what it could be good for is say your Social Security or your living expenses are $100,000, right? Social Security is covering 50,000 of that in your household. So there's a gap of 50,000 of your living expenses, right? You may want to have an annuity to cover part of that floor. So maybe you want to have an additional 20,000 of income just coming in no matter what's happening in the markets. And so so it's guaranteed, and it could buy you the flexibility of being more risky in your portfolio to try to get those returns, because now you have a guaranteed stream of income coming from multiple sources. And so we won't go into this, just know there's a lot of bells and whistles for an annuity. Term certain, you're just saying we want income for a certain number of years. Single life is over someone's entire life. And then joint and survivor is over your life and someone else's life. We talked about that. Okay. Common investment risk. So it's not just the ups and downs of the market. So we do have that market risk, and just know you can't diversify away from market risk. You can have the most diversified portfolio. Unfortunately, it's still going to go up and down. But you're good investors now, right? So you're not going to be selling when the market's down. Business risk, like we talked about earlier, if the company goes under, I mean, there is potential that these companies can lose value. So if you're buying individual stocks or companies like that, we would urge you don't do that, or have a fun account on the side that you're willing to lose everything. But I mean, even with the S&P 500, wouldn't recommend you just doing that, but we'd much rather see you in 500 companies rather than just a few handful of different names.
How about total market? Would you recommend against that?
Total market's good, like VTI, at least you have large, mid-cap, and small stock, but it's still all U.S., so that's much better than just the S&P. But again, we'd still say Brad will go into much detail with the lost decade and why you may not want to just be heavily weighted to, or all weighted to the U.S. I mean, and don't get us wrong, we love the U.S. Our portfolios are tilted towards we're U.S. home bias, but we do see the value in having that international as part of the portfolio. Okay, inflation risk. We're not going to make this mistake either, because we know that getting too conservative too soon can lose that purchasing power. So stocks will help keep that strong. Liquidity risk. It's potential that the investment cannot be sold quickly for a reasonable price. A number of years ago, there was real estate investment trusts, not to be confused with REITs, that were offering really high rates of return, but you lost the control of when you could sell out of these. And so we're seeing some issues with people that are having to hold on to these, and they need the income or want to sell it, but it's not being offered right now. So be careful of that. Know the reasons why you're investing in certain products. And then opportunity risk, it's just, okay, if I'm making a decision over here, what am I missing out over here? And then currency risk, this is a good one. I'm sure a lot of you want to travel in retirement. Right now, go do it. The dollar is the strongest it's been. Go do some international travel. But currency risk too, we also see, what's that?
Oh, you're just saying international travel. I'm like, oh.
And then again, put the investments in common risks here with market risk, business risk, interest rate risk, and inflation risk, and then the different vehicles and if they participate in those different market risks or investment risks. So now you guys have all done a really good job. You've saved for retirement, and you have dollars that you want to invest, or maybe you got an inheritance and you're deciding, how do we get this invested? We've already picked the asset allocation and how we want the portfolio designed, but what's the best strategy to do it? There's really two ways to get your dollars invested into the market. The first one is lump sum investing. You got $200,000 as an inheritance. You take it all, you diversify it and invest all at once. And statistically speaking, you would get a higher rate of return over the long term because all your dollars are working for you, right? What you want, just know that it may not be good psychologically for you. It depends on you, but let's say you put all the dollars in and then the market tanks the next day. Oh no, I need to sell and reduce risk, right? Don't do that. The first thing you want to do is, do you have 3 to 5 years of a time horizon where you don't need to touch these dollars? So if you know, hey, I'm not touching these for 3 to 5 years, and I want higher rate of return, then lump sum could work for you. A lot of the time, though, the psychological aspect can mess with your mind too much, and so you can do what's called dollar cost averaging. Let's say that you got $120,000. Dollar cost averaging would say that put the same amount in each month over a certain amount of time. Let's call it a year. It could be any time frame. I wouldn't go more than a year, then we're starting to delay things, but let's say a year. Then you're just putting in $10,000 a month into your portfolio every month without thinking about it. Most people think that this gets you a higher rate of return, but really what it's doing is reducing that short-term volatility. So what I mean by that is when the market's going up, you're buying less shares because the market's up. When the market's going down, you're buying more shares. So over that time frame, it's averaging out and then reducing the volatility along the way in the short term. Okay, perfect. So asset allocation we've touched on a little bit. It just refers to the process of diversifying a portfolio among several different asset classes. So we've talked about it a number of times, 7 to 9, and it can be 7 to 9 just different mutual funds or ETFs. You don't need to have 100 different funds in there to get the proper diversification. And so, do you want me to stop here? Or?
Yeah.
Okay.
All right, so Skittles chart. So this, what you're looking at here, everybody have enough time to fill out the questionnaires? All right, we'll grab them at the end of class. What you're looking at here is going to illustrate 3 really important truths, fundamental truths when it comes to investing. And as Matt said, it looks like a Skittles chart, so we call it a Skittles chart. Each one of these colorful boxes represents a different asset class or an investment that you can put your money to, different areas of the market. We have things like emerging markets. So that would be owning companies in countries that are considered up and coming. India, China. So think about the Kia car or a Hyundai, which is located in South Korea. That's a perfect example of a company that's located in an emerging market. Small growth companies. Well, let's talk about large growth companies. Large growth would be Apple today. A small growth company would be Apple back in 1978. A little bit higher risk, but a lot of upside. EFI stands for companies located in Europe, Australia, and the Far East. So developed countries and typically larger companies. So think about Toyota, located in Japan. That's a perfect example of one of the 4,000 different companies that you might find in this asset class. Here we find the S&P 500, the biggest 500 companies in the United States. Large value companies would be those big dividend-paying companies that have been around a long time, JP Morgan, Bank of America, those kinds of things. Small value would be smaller versions of that. This is a measure for inflation. This is a measure for short-term high-quality bonds. And then this is a measure for publicly traded real estate, or REITs, real estate investment trusts. Okay, now that we've got that established, let's look at the 3 truths let's talk about the 3 truths that I want you to take away. Number 1, risk and return are related. Meaning, if you want to get some returns, you have to be willing to take some risk. Now, there's good risk and bad risk. Matt's talked quite a bit about it, but bad risk might be owning individual stocks. Bad risk might be putting too much of your eggs in any one of these baskets or any one of these asset classes. Loading up, putting too much money in the S&P 500. It's a great index. You just don't want to have too much in there. Putting too much in the Magnificent 7. Those are examples of bad risk. Good risk would be owning a well-diversified basket of a globally diversified basket of securities, which is going to have higher returns, higher risk. Let me illustrate. So I'm going to pick on this. This column here shows your annualized returns. What if you put all your money into any one of these things back in 1999? So you notice I'm picking on a time period from 99 to 2013. You might think I'm cherry picking. I am, because there's some good stories, but then you're going to see, we're going to fast forward to recent times, and the fundamental truths still apply. There's different stories that apply the same lessons. So 99 to 14. If I put all my money in the emerging markets, I'm going to pick on this one, the yellow box, I compounded at 11% per year. I put $1 million in there. I quadrupled my money. I've got $4 million 14 years later. Okay. By the way, we would never let you put all of your money into any one of these baskets. But if you did, $1 million turned into $4 million, a really, really good return. But I'm going to show you why, even though that's a really good return, you would have hated the ride. You would have hated the ride. So in 99, you loved it. You're up 66.5%. And the next year you hate it. You're down 31%. Then the next year you hate it again, you're down 2.62, and then the third year the unthinkable happens. You lose money for 3 years straight. What do? You walk around saying, this thing's a dog, this is horrible, I'm not investing in the emerging markets, I'm selling the thing, it's a loser. What does it do? It goes on a run. It's up 55, 25, 34, 32, 39%. At this point in time, everybody's making a killing off emerging markets. Does it sound like Bitcoin to anybody? Anyways, sounds like everybody's making a killing. Your brother-in-law, your father-in-law, your neighbors, everyone's getting rich on the emerging markets. What do? You buy at the top, and you get crushed the next year, losing half of your value. You sell here, you lock in those losses, and these are the people walking around going, investing doesn't work. It's risky. It's like going to Vegas. It's just, oh, the rich get richer in Wall Street. And oh my God. No. Clearly investing works. It's our behavior to the way that the markets work. That's what's broken, folks. That's what's broken, and I hope to illustrate that here today. So you lock in those losses, and you miss out on 78, 18, down 18, up 18, down 2.6, so a wild and rocky road for a quadrupling, so a wonderful return, but a horrible and horrific experience to get there. So that leads to the second fundamental truth, that diversification is so important. Don't put all of your eggs into any one basket. You should spread them out into all these baskets. And I'm going to pick on a second asset class to make my point. REITs, real estate investment trusts. Let's say you put half your money in emerging markets, half in real estate. Again, we would never let you do that, but for illustrative purposes, let's say you did. You would have an interesting experience. It actually smooths out the ride. Half your money's in first place, half your money's in dead last place, so combined, you're somewhere in the middle. The next year, first goes to worst, and worst goes to first. Combined, you're somewhere in the middle. The next year, a positive and a negative, a positive and a negative. So what you see is the ride starts to smooth out a little bit like that. Okay, so that's how diversification can help smooth the ride. And yet, you still, these combined asset classes, you still quadrupled your money in 14 years. That's a great return with a much better experience. And the third truth that we're going to show tonight is that, look at this. Who can show me the pattern? Who can show me when you should get into something and when you should get out of something? Who can show me what's going to be in first place in year to year? And the answer is, there is no pattern. There is no way to predict it. There is no way to forecast it or foretell it. The truth is, my crystal ball broke years ago. And if anyone claims that they can somehow predict this thing, run, don't walk away from them, because they're lying. They're just not telling you the truth. But there's one thing you can do. There is one thing you can do, and it's not market timing, and it's not individual selection. It's using the asset class that tends to go up when stocks go down, and that's short-term high-quality bonds. And for the last 100 years, except for 2022, we can talk about that anomaly in a minute, short-term high-quality bonds tend to go up. Now, it's not a perfect science, but for the most part, this works. When stocks go down, the more they go down, the more the bonds go up. And so you could see after a 14-year period, obviously they're not at the top, but that's not the role that bonds need to play in your portfolio. And like Matt talked about earlier, our view of bonds Don't take risks. Don't do high yield. Go short term. Go high quality. Now that interest rates have settled in a little bit and the hikes are not as aggressive, maybe you want to introduce some medium-term credit as well, so 5 to 10 year perhaps. That may be could possibly the sweet spot right now, but historically we would prefer to be short-term high quality. But again, looking at the rate curve, the yield curve right now, you can make a case for going medium-term, but really we don't want any long-term, long-duration credit, and we want everything to be high quality, and that's how you buffer yourself from really bad years in the bond market like 2022. Even 2021 wasn't so great, but 2022 was a shocker. Good news is things have started to turn around in the bond market. Now, the fourth thing I'll highlight, so we're coming off of a 14-year period today where the S&P 500 has been lights out, red hot. Hey, why don't we just put all of our money in the S&P 500? Heck, Warren Buffett tells his wife that when he dies, just take his fortune and put it all in the S&P 500. It's diversified, right? Well, I want to point out to you that from 2000 to 2009, the S&P 500 lost 1% per year for an entire decade. Such that from 99, the peak of the dot-com bubble, through 2013, the S&P 500 compounded at less than half of its long-term average. Do you know what happened to the person who in 99 or 2000 put all of their money in the S&P 500, took out about 5% per year and retired? They retired, they started taking about 5% per year. What happened to that person? They went back to work in about 2016. This is the Walmart greeter that we see down there all the time, right? This is the person that went back to work. Yeah, seriously. So it makes the case you would never want to put all of your money into any one asset class. Here's the crazy thing. In fact, I'll show it to you on the next slide. So I'm not just cherry picking my data. Let me bring you back up to speed, but hold that thought, right? Terrible experience for 14 years in the S&P 500. Wonderful experience for 14 years in emerging markets. This is taking us to 2013. Hold that thought. Let me show you. All right. All right, and we're back. And we'll do this one. That one? Okay. So here's more updated data. I promise you I'm not cherry picking. Let's go look. So this is the period that just ended in 2023, looking back to where we just left off on that last chart, right? What's in first place? US large companies, AKA S&P 500, lights out, 12% per year for 10 years. 12% per year. So the long-term average on this thing's right around 10. It's outperforming its long-term average by 2% per year. How has our friend the emerging markets done? Not so hot, less than 2% per year for 10 years. So the point is, back in 2009, I had people going, hey Brad, we're gonna sell the S&P 500, right? It's a dog. It's a loser. It's a dead game. I mean, it's a new world order. Everything's global. Everything's globalized. New economy, new world, new everything. International, emerging markets. We're going to put all of our money there, right? U.S. dead story. U.S. dollar dead story. It's not going to be the world currency any longer. This is 09. These are questions that I got asked. Today, I get the questions in reverse. Hey, we're going to put everything here, right? And in both cases, I'm going, no, do not do it. Back in 09, no, do not do that. Do not ditch the U.S. The U.S. is going to have its day in the sun again. It's not a new world order. These things ebb and they flow. And guess what? If the 2000 to 09 period wasn't scary enough for you, it's not the first time it's happened. It's not just a one-off anomaly as a hangover from the dot-com bubble. No. 1928 to 1949, we had a 21-year period where the U.S. made no money in the stock market. 1966 to 1982, the market went flat. It was technically actually in slightly positive territory, but it underperformed cash, bonds, and inflation for a 16-year period. So these things happen. These things happen, and if you're not getting it, emerging markets, it had its day in the sun on the last chart that we saw, the 14 years before. It went ice cold. In the period when emerging markets was red hot, the U.S. went ice cold. That's how this works. These are long-term trends. Nobody can predict them ahead of time. No one can predict them. Why did this happen? Why did emerging markets, why did international investments not do so well? Is it because they're not good companies over there? No. The answer is actually really simple. In this time period, the US dollar got really, really strong. And I remember back in 06, 07, people were saying, oh, the US dollar, it's really weak. It's no longer going to be the world's reserve currency. It's a dead story. Again, these things ebb and they flow. It's the strengthening dollar that has caused foreign profits in the foreign companies to come back less than they actually are in their own currency. In other words, the international companies are doing fantastic. The US dollar's just gotten really strong. We're at a 20-year high. So if you like to travel, go now. Go travel. Travel as much as you can right now, because that's not going to last forever either. The US dollar will not remain this strong forever. Just like 15 years ago, I told people, no, the US dollar's not going away. It's not going to be this weak forever. Things ebb and they flow, okay? And now I want to draw your attention to the white box. And the white box is an example of a very moderate, some might say conservative investment mix. 60% stocks, 40% bonds. Of the stocks, 60% of the stocks are tilted towards US, 2/3 to big companies, 1/3 to small companies, 40% of the 60% tilted towards international, again, 2/3 large, 1/3 small. So a globally diversified mix. And the point I want you to see is that the white box is never once in first place. It's also never once in last place. It seems to cruise along. It's always somewhere in the middle. Not too high, not too low. And after a pretty rough 10-year period, this thing's compounded at 6.08% per year. Now, again, I said modest to conservative mix. If you said, hey, that's great, but what if I am comfortable taking a little bit more risk? Okay, maybe we'd say go to 70% stocks, 30% bonds, and now this thing starts to creep up the ladder and the returns start looking better and stronger. Should you be more conservative than 60-40? Again, we can't just give a blanket answer. Tough to make a case to get more conservative than that unless you have a whole bunch of money and you really want to get off the volatility train. So it's a pretty custom answer to your unique situation. But the big takeaway that we want to give you for diversification is illustrated right here. Good diversification means that you're never once in first place, and the trade-off for that, the payoff for that, is you're never once in last place, and you're not like the person who I mentioned who loaded up at the top asset class at the wrong time and went back to work 16 years into retirement. You want to avoid that situation at all costs. Make sense?